Hi, my name is Ray.
Hi, this is Michael.
Welcome to another episode of Ray's Economics Cluebook. Today, we're continuing our unit on measuring economic performance by talking about the second way to measure GDP.
Okay.
So last video we talked about how to measure GDP mainly using the C plus G plus I plus X method, or the expenditures method.
Yeah, we use the expenditure approach.
Yeah, the expenditure approach. And measuring GDP basically is all about this. This is basically a GDP right here.
Yeah, the flow chart. Yes.
The flow chart is basically your GDP.
I think that's really significant.
Yeah. This is the complete flow chart. It includes all four main entities of an economy: the government, households, firms, and foreign countries or the rest of the world. And it includes all the interactions that add and subtract into our GDP.
Yeah, for example, the good markets for goods and services, factor market, and financial markets.
Yes. Yeah. So first, we talk about the expenditure method of measuring GDP in the first video, which is basically consumer consumption, plus investment by firms, plus government spending, plus net exports, which is basically what foreign countries affect our GDP by.
Yeah, basically net exports means net expenditure by foreign entities in the United States, right?
Yes.
So yeah.
Then we talk about how there's two more methods. And today, the second method we're going to talk about is the income approach, because income in our economy is wages, profits, rents, interests, four main ways of income. And of course, there are two other things we'll talk about later: depreciation and indirect business taxes that don't necessarily get counted in income, but should be counted if we want to fully measure and accurately measure our GDP. And the basic implication from this chart right here is basically that expenditure equals income, or inflow equals outflow, or vice versa. Because from our circular flow model, we see that everything connects, and that inflow does indeed equal outflow.
Yeah, because everything basically it's pretty simple. All of your spending has to be equal to all of your income.
For instance, households through consumer spending in the markets for goods and services, eventually the firms receive the final products revenue, which is basically your GDP, which basically turns into your wages, dividends, interest, and rent for the factor markets. Yeah. So here we see the implication in the flow chart and on our graph that inflow equals outflow. Yeah.
Basically, we want to say the expenditure has to be equal into all of the factors of production income, right? Factors that earn the incomes. Okay.
So basically, first thing we're talking about, the first part of our income is basically national income. National income is basically income for our four factors of production. Now, very early on in economics, talk about our four factors, which is land, labor, capital, and entrepreneurship.
That's basically for the resource, right?
And so, for labor, the main ways of income are basically your wage or salary, and maybe benefits as well. Yeah. For land, it's rent. For capital, it's interest or dividends. And for entrepreneurship, it's basically profits from your
incorporated business or non-incorporated, like sole proprietorship, right? So,
So that's pretty basic part of our income method. However, the second part is we need to make adjustments for what national income does not count, but that expenditures does count. Yeah. So basically, the indirect business tax is basically one thing we need to count, because the indirect business tax is counted in our expenditures method of calculating GDP. Yeah. Basically, it's the intermediary steps of a business that are taxed by the government, such as a sales tax or a value-added tax, which is used in a lot of European nations, and are minor things like license fees.
Yeah, basically, the indirect business tax is kind of like business is just intermediary; they just collect the money. Okay, and it's not really counted as any factor of income, but it is
part of our
GDP. The expenditure.
And it's part of our GDP. So think about it.
For example, investment spending, they of course including license fees, right?
So think about it as basically the part of our GDP that sent to the government, that's not counting our national income, but still technically GDP. Yep. And so secondly, we have depreciation costs that are technically part of our investment expenditures, but are not counted in national income, even though investment is part of our GDP. Yeah. For instance, if we have a Walmart and we have Walmart's one of their warehouses is deteriorating, and they hire a contractor,
like ABC
contractor, to fix the
just
warehouse,
renovate the warehouse.
That's technically part of our GDP. However, this is not counted because the income affects cancel, because the income is canceled out by the expenditures, and it's not counted in our national income.
Yeah, it's basically the income effects cancel each other, because anything Walmart paid to ABC contract as a renovation is kind of like counted as Walmart's cost.
Yes.
And counted as ABC's revenue.
Yes.
And when we add up all of the profits from the business, and they cancel each other. But in investment spending, they just counted at once.
Yes.
Okay, kind of like Walmart investment, right? Invest on their own warehouse, right, to renovate that. So that's very important, because depreciation could be a very big part
of our investment.
Could be a very big part for the investment spending, because investment spending may not necessarily just always build new factories. Right, they could renovate, expand a regular Walmart into a Walmart ship center, for example. Okay, so that's very important part. So.
So at the end of the day, we can see here, based off our clue graphics from our first two slides, basically we can see that it helped us learn more efficiently about GDP and its methods, and see how it all connects. Because we see how the expenditures, or from four entities, consumer spending, investment, government, and net exports, how that relates to our income, and basically how those two are basically equal, and we can calculate GDP using both methods through our balance chart.
Yeah, so I think that's really a very interesting and a very important part. The clue book itself, is built upon all the different clues, and graphics could be a very powerful and efficient way to present the clues.
Yeah.
In just one piece of paper, or one graph, and that could contain all the information that you should learn and you should memorize from this chapter. So I think that's really great, and look forward for your next episode. See you guys. Bye bye.